Welcome to my channel. I am the covered call guy, and my goal is to create $120,000 per year passive income portfolio using only covered call ETFs. Right now, my portfolio yields about $72,000 a year, about $6,000 a month, and about $1,400 a week, and almost $200 a day. So once I reach my goal, I'm open-minded. Let me know, leave a comment, and let me know what I should do. I'm not gonna sell any of it. I might just increase my goal to 150, 160, or go back into traditional growth dividends. I'm open to all ideas, so leave a comment. Legal disclaimer before we start this great informational educational video today. I think is going to be one of my best. I think it's a fun video today. This content is for informational and educational purpose only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. Please, please, please always do your own research and consult a licensed professional before making any financial decisions. Remember, I'm just some random idiot you find online and I could be completely wrong. And thank you to all those who leave a comment saying, hey, you missed this part in the video. This was an important fact. And or you leave a comment saying, hey, this is wrong. This is you made a mistake. It's not, this is the fact that I put in the video was indeed wrong, not a fact, and you get pinned for it because I want everybody to say and see that hey, this is a mistake and correction needed here. So thank you for that. All right, with that out the way, today's video is going to be on the high yield awards. I just gave it this name. uh I couldn't really think of a better name than high yield awards, the income and crypto landscape. We're gonna be doing 8 funds today, a Sherlock Holmes style forensic analysis, and we're gonna be focusing on the yield focus also. We're gonna determine all of that, and that's how I came up with the awards for each fund landscape. We start off with the basics, the structural alpha, the evolution of modern income portfolio. This is my opinion. This is the call guy's opinion. This is my channel. The investment landscape of the mid-2020s have shifted from passive beta accumulation to structural alpha. The maturation of derivative market have birthed the active options overlay ETF, a vehicle that monetizes volatility, time decay, and tax arbitrage. This report provides a forensic analysis of 8 category winners for 2025, which is my opinion. Okay, my opinion. Unlike standard summaries, this document focuses on structural mechanics, how the yield is manufactured, stress testing, what breaks the strategy, and operational due diligence, right? Counterparty and executional risk, like how I do all of my videos. I try to break it down to the pros, the cons, the good, the bad, the beautiful, the ugly. All right, the winners circle, the 2025 category winners for a curve, the single stock long. Like what it does is credit spreads and dynamic strikes to preserve upside. XFund BLOX is the crypto fund. Hybrid Trinity structure, equity plus fund plus options. Roundhill and Rex is the best for trading vehicle. Swaps for leverage, no upside cap versus 2x daily leverage. NEOS is the best index for set and forget. Section 1256 tax efficiency and call spread mechanics. YieldMax is the sector fund, weekly payouts for semiconductor sector volatility. Goldman Sachs is the best for U.S. options income, dynamic coverage 20 to 75%, and institutional execution. JPMorgan JEPI, right, is the best equity premium, ELNs for defensive income and lower beta, and TappAlpha is they win the category for daily income, right? 0-day time exploration, execution, and daily resets to uncapped upside. But let's break it down one by one. And we started with Kurv, right? Why do I think Kurv wins the title for best single stock long? The headline thesis for this is the undisputed long-term hold. All right. My idea for this thesis, why it is the undisputed long-term hold for best single stock, right? Kurv differentiate itself by explicitly prioritizing total return over maximum yield, while their competitors often cap upside by selling at the money. If you ever hear me say ATM, that's the short for at the money. Calls to advertise triple-digit yields. Kurv is built to preserve capital appreciation, right? And then we do the Sherlock Holmes forensic mechanics. They're overlying these design uses credit call spreads, selling lower strikes, buying higher strikes, to create a defined upside rather than a capped upside. Synthetic exposure wrappers may use synthetic exposure swaps or physical holdings combined with derivatives. So they have that options to either hold it or use synthetic, right? So they have both options here. All right, Curve stress test and operational checks. Again, this is my stress test. This is how I kind of formulate and kind of give it that um, illustrative purposes, right? This is my stress test. People might have different metrics of stress testing, but this is the way I break it down. Breaking the strategy, right? So the rally, the buyout risk. If the underlying stock rallies 30% in a month, Curve credit spread allows participation up to the short strike and potentially pre-participation above the long strike. The gamma squeeze, and a squeeze, implied volatility, which is the IV for short, spikes. Curve benefits from selling higher premiums, but execution becomes difficult. So it can break their strategy if these happen. The operational and counterparty checks, execution venues, request execution logs. Are they executing on SIBO or MIAX or via over TC flex option over the counter? OTC executions can offer bespoke terms but may suffer from widespread slippage. So, depending on who they trade and where they trade and what market they trade in, can give them the benefit. I can't get into bigger details in this because this is kind of behind the scene. Hedge funds, they have kind of their unspoken rules for hedge fund dealing with hedge fund dealing with bigger banks, hedge funds dealing with other people with 100, 200, 300 million dollars, and so I can't really get into the details because it's a lot of behind the scenes and it's not really public like that. Credit spread risk. The prospectus explicitly mentions this risk, indicating sensitivity to pricing differences between options bought and sold. All right. Best crypto fund, XFund, BLOX, right? Headline thesis for this is the hybrid income engine. Block wins by employing a hybrid trinity structure. It holds crypto equities, right, the miners in exchange. It holds spot slash futures ETFs, indirect exposure, and an option overlay. This structure avoids direct custody risk while harvesting massive volatility. Forensic mechanic behind this, the no custody wrapper, indirect exposure, invests in underlying funds, right? ETFs slash ETPs and equities like Coinbase, no wallet, no keys. The option overlay, right calls on individual holdings, Coinbase and ETF positions. Yield is derived from equity volatility. So they're pretty much able to have some sort of protection if one goes down. They kind of switch over and kind of buffer the losses and or try to recapture gains in other areas. BLOX, my key risk and stress test, stress testing the strategy, correlation drift. Crypto equities such as miners, right, act as leverage plays but carry business risk. If Bitcoin rises but mining difficulty spikes, miners, stocks, and blocks could lag significantly. So there is a derailing kind of risk, right? The price go up, but blocks may not follow. Of course, it's very volatile. That's what it is. Regulatory shock, a regulatory enforcement action against a major holding like Coinbase, which could happen at any time, could cater the fund's equity sleeve, a risk not present in a pure spot like BTC ETF. And of course, what it distributes, right? How sustainable it is. The high headline yield depends on sustainable high IV in crypto stocks. If crypto volatility compresses, what it distributes will shrink. Right? Operational check requests a daily correlation matrix the fund's holding versus spot BTC. The best trading vehicle goes to the award goes to Roundhill slash Rex. These two are the best for best trading vehicle. If you are an active trader, these two funds would fit you the best, right? They fit your style the best. Headline thesis for this is because they have good velocity and uncapped leverage, right? Roundhill's weekly pay and Rex series are definitive tools for active traders. They offer high volatility payouts and leverage without the structural drag of capped cover calls. The forensic mechanic and traps, though, the no option twist. MSTW explicitly does not sell options. It uses swap agreements to achieve 1.2x daily exposure. The weekly pay is a managed distribution derived from trading gains, not option premiums. It's critical because MSTW is a leverage vehicle with uncapped upside, not a yield trap. Roundhill and Rex operational checks. We always got to look how they operate, right? Market microstructure checks, leverage source. Rex and Roundhill use swaps or futures, identify swap counterparties, and review ISDA terms for credit limits. This is mainly what hedge their fund is going to do, right? They encounter this when they have this type of money backing them. Path dependency, Roundhill target calendar week returns, Rex target daily leverage, right? A volatile week that ends flat will decay a daily leverage fund more than a weekly reset fund. How they distribute? For MSTW, distribution may be return of capital or capital gains. Traders must understand this is a liquidation of upside. Of course, it's leverage plus it's daily or weekly. But if you're into these two, is the best for the active traders. Best index set and forget. The award goes to NEOS. If you are if you want the index and you want to buy set and forget, NEOS is your fund, right? My headline thesis for this is the tax alpha architecture that NEOS imposes. NEOS dominates the core allocation space by engineering its fund for tax efficiency. We've seen it. If you own it, this is why they're loved. This is why they're so popular. This is why it's part of almost everyone's core for cover call ETF slash income investors. By writing options on the index itself, which is the XPX and NDX, rather than the ETF, right, SPY QQ, they secure Section 1256 tax treatment, which is just 60% long-term slash 40% short-term capital gains. The forensic mechanic behind this is that index versus ETF options is their secret sauce. Their prospectus confirms Section 1256 contracts, distinct after tax yield advantage over peers like JEPI. Call spreads, which is their collar, which is just means their defensive style. NEOS buy out the money calls to protect against melt up. If S&P rips 15%, the long call allows participation beyond a certain point, right? So this is what makes them so good. They don't just give you back more of your money from tax efficiency, but they also try not to cap your upside, and they allow for downturn buffers. NEOS tax and distribution due diligence, right? So we always gotta look at that part. Their diligence items is what they distribute and how it's characterized. Even with the 1256 benefit, a portion of the distribution may be return of capital. NEOS uses rock constructively, which is again constructively, right? We want it to be constructive and good to defer tax liability. Ask for a 10K style breakdown of rock versus net investment income, right? You want to ask yourself that. You want to break it down yourself and see how it is. At the end of the year, you to get your 1099, and you always want to compare. You always want to see how well they're actually doing. Capacity and liquidity with an asset under management in the billions. 6+ for SPY. NEOS is a whale. They're getting up there. They're catching up to the Goldman Sachs and JPMorgans, right? Always verify how they execute large block trades without moving the market. That's slippage. So when you start seeing how their price is kind of moving away from the index, that's when we have to start questioning, oh, what's happening here? The best sector YieldMax, Chippy. If you want the most aggressive for the YieldMax, Chippy is the winner. Right, YieldMax right here. Chippy's champion. Right, Chippy is YieldMax champion. My headline thesis is for sector volatility harvesting. YieldMax Chippy, which is their semiconductor options income, applies a high frequency weekly option engine to a diversified basket of semis. NVIDIA, Broadcom, AMD. It harvests the sector beta volatility to generate massive yield at 40% plus annualized, of course, while uh, distributing weak cash weekly. The forensic mechanic behind this and the traps, right? We always got to ask the pros and the cons. Weekly cadence, increasing compounding potential, but requires precise cash flow management, and also for the VIX to really be on their side, right? Because of with such high yield, they depend on the VIX and their underlying stocks to actually kind of go on a tear, because that's what is keeping Chippy on that amazing run. They use flex options, which it's not going to be known for the retail investors, but I don't have to really worry about that. It's just informational purposes. Flex option is mainly for the big boys. I generally utilize flex options to customize strike prices, improves fit but reduce secondary market liquidity, because it's really flex options really only bought and kind of traded with other hedge funds or big banks, or the people with at least $100 million. YieldMax operational checks and risks for Chippy, right? Holding risk. Unlike single stock NVDY, Chippy holds a basket. This mitigates single name ruin risk, but exposes the fund to sector um, uh, oh my god, this is gonna give me a terrible. This is terrible. Cyclicality. Oh my god, if the semi cycle turns, inventory gulps, right? The entire basket drops, and the option overlay cannot fully offset a 40% sector drawdown. And as I mentioned before, some Chippy has two stocks that makes up 25% of the basket. So remember, when that cycle starts turning and starts shifting from the AI or the tech, it's going to hurt Chippy in this way. But right now, it is YieldMax winner. Collateral management. The fund holds U.S. Treasuries, T-bills as collateral for its synthetic positions. As right now, I don't think it holds any synthetic. It actually has the underlying diligence item. We always got to ask, right? Verify the collateral waterfall. How is the cash managed to ensure weekly payouts aren't disrupted by margin calls? As right now, because they're on such a tear, shooting upwards, they're not worried about the margin call. We just have to be aware that when the market starts turning down, prolonged bear market, then it's a chance of them actually having to possibly use that collateral if they have synthetics. The best U.S. option income, Goldman GPIX, right? Dynamic coverage ratio. The Goldman Sachs asset management here. Goldman Sachs wins on reliability and cost. GPIX and GPIQ employ a dynamic coverage ratio, typically 20 to 75%, that adjusts based on the market signals rather than a static 100% overwrite. With an expense ratio of just 0.29%, they commoditize the active income space. So this is a direct copy and paste from the website. I didn't want to change anything. I didn't want to use it in my own words, because they explain it so well themselves that it's just, I just put it here. This is why they win. This is why they have that award of the best U.S. option income. If you want the dynamic coverage, Goldman wins. The Goldman Sachs tax and operational checks, right? The forensic mechanic behind them. Dynamic coverage bands. Their prospective states coverage resets monthly, 25 to 75%. Allows capture of significant upside during bull runs. This is why they outperform. If you guys on my channel see my posts, GPIQ has beat all of the other Qs. I created a post about this. The returns has been amazing. Their execution edge, as massive liquidity provider, Goldman likely achieves execution alpha, right? Narrower spreads on option rows, which is hidden but accredited to NAV. The reason they have execution alpha is because they are such a big name that everybody wants to have a piece of Goldman, right? This is why JPMorgan, they have such a strong uh, call and ask bid. It's because everybody wants to do business with JP Morgan. They have so much money in backing that you get the best price, right? So this is the same way of thinking of it as Goldman Sachs. NEOS is getting there. So once NEO get there, we're gonna see even better returns for NEOS. Tax and operational checks, low fee advantage at 0.29%. GPIX is structurally cheaper than NEOS or JEPI. Over 10 years, this adds up significantly. What the distribution mix? Distribution or a mix of dividends and premiums. Expect lower absolute yields, 8 to 10%, but higher quality, less destructive rock compared to 50% yield funds. And this is why they get this award. In my opinion, the lower absolute yields, 8 to 10%, aligns with traditional S&P growth. The market, right, is in line with them. It is 100% sustainable. Once you start getting outside of that 10-12%, then it starts becoming, okay, where is the yield coming from and how you're going to execute these strategies to maintain it. At 8% is very achievable. You can obtain 8 to 10% all day, every day. The best equity premium goes to JPMorgan JEPI. My headline thesis behind this is because it is the defensive bond substitute. JEPI and JEPQ are the standard bearers for defensive income. They utilize equity-linked notes, ELN for shorts, combined with a low volatility stock selection to deliver a smoother ride than the S&P 500. In my previous video, I said JEPI is the new SCHD because of how defensive it is, how consistent it is reliable. The only drawdown is it uses ELN structure that has no tax treatment that's efficient. So that's the only drawback to it. The forensic mechanic behind them is the ELN structure. JEPI does not sell calls on exchange. It buys ELNs with structured notes from banks. It does business from bank to bank. The risk is that introduce counterparty risk, because if it does business with a regional bank and a regional bank kind of fails, then the ELN becomes worthless. Let me say it again. It becomes worthless. The tax treatment, is the gotcha, right? Income from ELN is ordinary income, interest, not qualified dividends. Creates a tax drag in taxable accounts. So yes, it can be upwards of 37%, right? 1/3 of your income gone. So there is for high income earners. Hopefully all of us are going to be high income earners. There's something to think about. There's nothing wrong with having JEPI. It's just something you want to think about if you want to keep more of your money, right? If you're like, hey, I don't want to give my money away, then the JEPs are not for you. If you're okay with, you know what, I want some core defensive income, a rock in my portfolio, and I don't mind paying a little bit of taxes as long as it perform well, right? Keep some. Have some in your portfolio. Nothing wrong with that either. All right, JPMorgan, the operational checks. How we gotta always understand how they're operating behind the scenes, right? My due diligence items, my two checklist items for this is the counterparty register demands a list of ELN issuers, right? Toronto Dominion, which is was that TD Bank, right? RBC, UBS to access credible credit exposure. So they're doing business with bank to bank, and sometimes if Canada's economy starts slowing down, it affects TD Bank, right? So a lot of these things can happen and affect you. The defensive beta, right? Verify the fund's beta relative to S&P 500. JEPI has historically run at about 0.65, right? Confirming its utility as a volatility dampener. The best daily income, the award goes to TappAlpha. My headline thesis behind this is that it has the daily reset revolution. TappAlpha is the cloud native winner. built specifically for the 0 day time expiration era by writing options that expire daily and resetting the strike every morning 9:30 to 4:30 to 4 p.m. Eastern Time. T-SPY and T-DAC solves the capped upside problem of monthly funds. The forensic mechanic behind this, the daily reset mechanism. They sell 0 day time expiration calls 0 to 5% out the money each morning, captures the overnight drift, and re-participate in multi-day rallies. So T-Alpha, the award for best daily income goes to them. So if you're into the daily income strategy, T Alpha is your fund. T Alpha, my stress testing and due diligence, right? The stress test here is execution dependency. Trading the entire option book every single day creates a massive operational overhead. Slippage on a 0 day time expiration options can destroy alpha. So that's the risk too, right? As the market goes down, you're trading the losses. Path dependency, while superior in trading in bull markets, 0 day time expiration strategy can suffer whipsaw losses and high intra volatility, right? Market opens up, rips higher, then crashes. So you trading and trading the losses and locking in the losses. My diligence item for this is demand execution quality reports and daily trade blotters, right? You need to be on the website looking at what they're doing. You need to be following their social media to see what strategy, what they're doing, what they're trading. You need to be reading their notes. You need to be going ahead and following up on all of the reports, right? Everything they put out, you have to be reading that. Yield versus complexity landscape. This is just a chart that I kind of put together, right? High yield often comes with significant higher operational complexity and risk, as you can see. YieldMax, the chippy, does have the highest, so it has the highest complexity here. Then it followed by BLOX, Crypto, and then TappAlpha, JPY, NEOS, Goldman, and Kurv, right? So pick and choose how you want to play this, because the higher it is, the more risk you're taking on. However, typically high risk mean high reward. So it just depends on your tolerance. That is all. Just depends on your tolerance. Inside the block structure, we're just going to go a little bit showing the chart here, because I did not want to put the chart in the beginning, because it just didn't mesh well. XFunds blocks avoid direct custody by utilizing a 3-pillar approach, harvesting volatility from 3 distinct sources without holding coins, right? We have equity exposure 40%, spot ETF slash proxy at another 40, and options overlay at 20%. All right, comparative risk profiles, right? Sector risk, YieldMax Shippy, high sensitivity to sector drawdowns if semis crash. The principal erodes fast. Execution risk from TappAlpha, reliance on daily 0 day time expiration execution. Operational complexity is the main threat here. And then upside capture, right? If you're holding JPMorgan JEPI, the safest floor, but the lowest ceiling, right? You will trail significantly in a bull run. Cross fund diligence matrix here, right? We're looking at 12-month option blotters, report request strike prices, expirations, and nominational amounts. Check realized mid price versus executed price to quantify slippage, distribution, composition report, exact breakdown of return of capital, ordinary income, qualified dividends, and capital gains, right? Short term, long term for the trailing 12 months. And what I mean by here is you can always they have an email, and you can always request stuff like this from them. Sometimes you get it on a timely manner, sometimes you won't. I forgot whom I requested from. I think one of the funds I've requested for. By the time they gave it to me, it was like, all right. I thought it was gonna be like a 24 to 48 hour turnaround, but they gave it to me like after a week. It took a while. So I was like, I don't need this anymore. So this is something you guys can always do, right? You can always contact their team, be like, hey, I'm this and this. I own, NEOS. I'm just interested in blah, 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 blah. Can you send it to my email, the reports? I can't find it on your website, blah, 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 blah. This is what I mean. Always do your own due diligence, and if you have a question, you can find it on the website. If I can't answer it, right, you gotta do your part, and you can go and contact them. Counterparty register for ELNs, JEPI, and swap. Roundhill Rex funds require a list of counterparties and credit exposure limits, execution daily quality report, average realized bid and ask spread capture. All of this information they should be willing to give you, right? You're an investor, right? I mean, for the big boys, they might not care, right? JP Morgan, I'm like, who's this guy? Whatever, right? But for the most part, um, these funds should be willing to give it to you. Stress test simulation, right? Always ask the issuer's own profit and loss simulations on their plus 30% meltup rally. This stuff, they're not gonna give it to you. I just something you can request, but this is more of like kind of doing your own little chart here that I do. Like in my head, I'm like, all right, I got NEOS. How is it gonna do in a 30% meltup rally, 40% sector drawdown, 50% drop in implied volatility? You kind of have to kind of guess these yourself. And then my verdict, right, for taxable accounts, NEOS, SPY-I, QQI, right, superior choice due to Section 1256 tax efficiency. The bullish traders, Roundhill, Brex, right, offers leverage without upside cap of covered calls. Defensive income, JEPI, right, the safe haven due to its low volatility equity basket and institutional scale. The total return, right, Curve, the only responsible choice for long-term holders who want to retain upside. Then Curve gets the best of this. I mean, Curve doesn't win this, but to put in each category, I gave it to Curve, right? This is the winner here, but this is what they're kind of known for. That's what they're aiming for, and that's why I gave them to them. So don't leave a comment like, oh, well, NEOS and JEPI is good too, and others. Yes, for this purpose, I have to put one in each category. Curve wins my award for this one because this is what they're aiming for. So they're doing well so far. I'm gonna give it to them. My final verdict: choose the tool that fits the job. Right? Don't use a hammer, which is like YieldMax. I mean, you need a scalp like NEOS. So know what you own, know what you choose, know how the strategy is. Thanks for watching. Subscribe, comment, like, join the community for more forensic fund analysis. Appreciate you guys for watching. I hope this was informational, educational, and fun. Again, leave comments if I've missed something. If you agree, disagree, I appreciate you guys. Catch you guys on next. Stay tuned.